Good Monday. This is Jay Brew, co-chairman of Seafreedom Brew. Last week we talked about event triggers and the importance of it as maybe a balance sheet strategy. And what I said last week is that we'd actually look at an actual event trigger strategy in terms of what you can do with, say, the investment portfolio in case interest rates start to move up, and use it as an asset liability strategy. So let's look at it from the standpoint of setting an event trigger. For instance, one can put it in the 10-year zone. That right now, the 10-year being at a 1.41%, that the event trigger that might start your balance sheet strategy might be moving up to a 2.50% on the 10-year Treasury. Why did I pick that level? Well, let's look at it from the standpoint that what if we picked 1.75%? The thing is that this essentially now is the trading range that we've seen the 10-year under for the past 2 years, somewhere in this neighborhood, so that we don't want to get caught that suddenly rates move up over 1.75% and then something like in Europe happens that then takes us back down again. So that we pick an event trigger that really gives us a lot of leeway. Then what we do is that we look at the investment portfolio. And what you want to do is to look at your overall gains that you now have built into the investment portfolio. So that part of the strategy would be to select a group of investments that may go into gains and losses in case we hit that particular event trigger on the 10-year Treasury. And you want to make it so that you can use these gains to offset some of those losses. For instance, last week I said that putting cash to work in here, a lot of people very nervous about the risk of going out longer on the yield curve when we're down at these very low rates. So the way to look at it is that we can go out and purchase in here with that cash, say like a 15-year mortgage-backed security, amazingly enough around a 1.60%, and we can put that into the investment portfolio and at least get better than the 0.25 on overnight money. We could also look at a strategy of buying tax exempts in here, which are still relatively very high yielding. And once again, then we look at this part of the portfolio that has gains. And we set, once again, if the event trigger goes up to a certain point, that then we will look at this whole strategy to sit there and say, do we want to pull the trigger in terms of taking some of the gains, offsetting it versus what may be losses in this part of the portfolio, and then bringing everything back into a cash position again. So as we talked about, that this is an asset liability strategy. It's one that can help to protect your earnings in the environment we're in right now as a low interest rate environment, and also if interest rates head up. One can also build in part of gains that can go along with this cash in order to protect the bank's earnings during what might be a short-term period where interest rates continue to rise. So when we look at this type of overall strategy at a time like this, is that it puts us into a position where we can control our earnings and at the same time control our risk. And you can think about this in many different variations. You can put this as part of your overall investment policy and overall investment strategy. You can also put this into your ALM model to see what amounts that you need in order to correct your interest rate risk if rates head up. But the important thing is is that at least you'll have earning assets on the books if interest rates continue to remain low. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.